Unit 9, Property Insurance Basics. This chapter is just a short little chapter. It'd probably only be worth one or two questions on the exam. Property insurance is important. Having said that, it's mostly going to be a vocabulary issue. And so let's take a look at some of the vocabulary, some of the circumstances that come along with this and prepare you for test purposes. Objectives in this chapter include, we're going to find basic property insurance terms, discuss and differentiate between HO3, HO4, and HO6 policies. You'll see what that means in just a moment, and those are the only ones currently listed on the syllabus from the Real Estate Commission. That's why we choose those specifically to deal with. Continuing with the objectives, we're going to explain the purpose of flood insurance and determine when flood insurance is or is not required. That, of course, will be an important test factor. So you will want to pay attention to that specifically. Maybe read it in your book, make sure you have that down pat. And we're going to describe the broker's responsibility regarding property insurance. At the end of the day, we're going to a broker class. And so we do want to help you understand how to advise your clients in regards to this. So what is homeowners insurance? Well, homeowners insurance is exactly what it sounds like. It is insurance that is going to insure the home, and you may not realize this, but it also insures the content as well. So when we look at an HO3 policy, an HO3 policy is what is referred to as an all-risk policy. In other words, when you get this policy, it covers you for all things except items that are excluded. So in your notes, also make note of the word exclusion. What exclusion refers to is something that is specifically stated that it would not cover. So for example, your HO3 policy, it will cover all risk, excluding earthquakes. In our area, it might exclude earthquakes. It's very typical for HO3 policies to exclude flood because you have to buy separate flood insurance for that. So your bullet points on this, HO3, all risk policy, it is the most common type of policy for homeowners. It does in fact include both coverage for the property itself, the real property itself. It includes coverage for your personal property, and it also includes liability coverage. So if someone were to come to your property, slip and fall and injure themselves, or if there was a dog on the property and the dog bit someone, then your homeowner's insurance would cover that as well. However, when it comes to pets, keep in mind that insurance companies may have policies that say, we're going to charge you more if you have a pet of a certain breed or something to that effect. So it would be important for you to understand the insurance needs if you have things like that. Continuing on, you would see that an HO4 policy is what we refer to as a renter's coverage or a tenant policy. Now, think hard about this one. Once you know that HO4 relates to a tenant, basically what we're talking about here is someone who lives in a property. So this house is owned by someone else, or this apartment is owned by someone else. So it doesn't have to cover the structure. What it's really going to cover is the renter's personal property. So HO4, renter's coverage, tenant policy, you might hear it called, and it covers just personal property. An HO6 policy, a homeowner 6 policy, is what is referred to as a condominium coverage. Now again, think about what you know about condominiums. In a condominium form of ownership, what one owns is actually the airspace inside of a building. So again, you don't have to worry about covering the structure itself. The condominium ownership, the condominium itself will include insurance on the common areas. Remember that in a condominium complex, you own the airspace and then the tenants in common own the common areas. So the common areas would be covered by a master policy. So basically what you want to own as an owner, or what the insurance you want to have as an owner, is called an HO6 policy. And as you might imagine, it's going to cover the contents of that property. Now keep in mind, the contents of a condominium also includes things like, well, the cabinetry, the interior walls, your carpet, your paint, your wallpaper. All of those type things would be covered if there were a fire, for example, inside of the property. The HO6 policy would cover that. HO6, condominium coverage. Vacant property is kind of interesting from the standpoint of an insurance policy. You would think that, well, it's vacant, so what could possibly go wrong? Well, the way an insurance company looks at vacant property is if it is vacant, there's no one there, no furniture in it, it's a target for vandalism and things like that. So vacant property insurance is actually not only expensive, but sometimes it's hard to maintain. So you might want to talk to your clients about this. If they are leaving a property that is literally vacant for a period of time, they absolutely need to talk to their homeowner's insurance company just to make sure that they're going to have adequate coverage for that. And if it doesn't dawn on you yet, think about a vacant property. What are you going to do if it has a water line break or something like that? Nobody's going to be living there to pick up on it. What's going to happen if someone breaks out the back window and basically moves themselves in? Well, if it's on the back of the house, it's possible nobody would detect that for a period of time, and you may end up with a squatter on your hand. So vacant property, a little bit tricky there. Unoccupied building is a slightly different category. Now, with an unoccupied building, it's considered to be, it's still no one's living there, but it's usually for like a second home or something like that. An unoccupied building would still have the furniture in it because the seller plans or the owner plans on coming back. Having said that, it could be difficult for insurance as well. So you would want to discuss that with your homeowner's insurance agent just to make sure that there is no certain time frame that could be problematic if it's going to be unoccupied for a period of time. Vacant means it's literally vacant, nothing in the house. Unoccupied means that it has furniture in it, and the homeowner does plan on coming back to it at some point. Think about a second home, a vacation property. The next topic is the CLUE report. CLUE report stands for the Comprehensive Loss Underwriting Exchange, and it's basically a database that insurance companies, when a claim is filed, they report it to they report it on the CLUE report. That way there's a record, and the record actually follows people. So for example, if you have a buyer who has a history of filing a lot of claims, their insurance company would certainly take that into consideration when pricing their policy. Having said that, the property itself is also noted as well. So there would be a database regarding the property and its history of claims as well. You are entitled, under the Fair Credit Reporting Act, you're actually entitled to get a CLUE report every year if you wanted to check and see what the insurance companies look at when they're seeing you or your particular property as well. But the CLUE report could be valuable information in helping to determine the insurability of a property. So get used to that, get to know an insurance agent really well, and get them to help you understand what the CLUE report is. This is very tricky for exam purposes. What if the buyer moves in or a seller stays after closing? The reason that this is an important topic is this comes up in the contract chapter as well. In the contract chapter, we talk about the fact that possession is normally exchanged at the closing table. Having said that, there are times where the buyer needs to move in a little bit earlier, a buyer possession before closing. Or there will be time where the sellers may be waiting for their new home to be finished and they need a seller possession after closing. Well, think about this for a moment. You cannot have a homeowner's policy on a property unless you own the home. So think about this. If the buyer moves in early and the seller still owns the property, well, the seller's the homeowner. So the buyer can't have a homeowner's policy. So what the buyer would need to obtain is the equivalent of a renter's policy. You remember the HO4. Simultaneously, the seller doesn't look like a home, well, they are a homeowner, but they don't look like they're living in the home if they're leasing it out to someone else, if the buyer has possession before closing. So what the seller would need to do is talk to their insurance company and say, hey, do I really need to look at a landlord's policy as opposed to a homeowner's policy? So these possessions other than closing, don't try to take this burden on yourself. Get them to the insurance company and say, hey guys, just full transparency. Let them know what's going on. I would hate for there to be a loss during that time period only to find out that neither of the parties had the appropriate coverage. We mentioned this in the previous slide, and just to re-emphasize this, in your offer to purchase and contract, the standard one that we use in North Carolina, the risk of loss is maintained by the seller up until the time of closing. So again, when you run that through your mind, if the seller's maintaining it up to the time of closing and the buyer moves in early, the seller is still responsible for that. Interestingly enough, when I bought a property, you often hear people say, don't buy property late in the day on a Friday because it can't be recorded until some other day, typically the following Monday. Interestingly enough, when I purchased a house in Carver years ago, we closed on Friday. It's like 4 o'clock. It was the only time that we could get. And of course, the attorney did not record. This was back before they were able to do electronic recording, so it wasn't nearly as efficient as it is now. But we moved into the property on Friday, but we didn't own the property yet. The seller still owned the property. Why? Because it was not recorded in the buyer's name yet. So our homeowner insurance policy could not kick in yet. Interestingly enough, over that weekend was the weekend that Hurricane Fran came through, and it actually affected the area that we lived in. We had some driving rain that blew in through some of the windows, and we had the unfortunate task of calling the seller on Monday and let them know that they had damage to their home. And they said, well, no, you have damage to your home. And I said, well, sorry, it didn't record on Friday. This is still your home. Your homeowner's insurance would apply. Imagine if an agent had not been heads up on that and the seller had canceled their homeowner's policy on Friday at 4 when the alleged settlement meeting closing was to take place. So this is a big deal to understand the risk of loss. Hopefully you never run into that particular situation. But having said that, that's why it's so important from an insurance standpoint to understand who maintains that risk of loss. Notice the question on this slide. Very simple answer to this question. Does homeowners insurance cover floods? The answer is no. In pretty much all policies, the flood is not covered. Now, you can buy flood insurance. Matter of fact, anybody can buy flood insurance. There are some homes that are going to be required to carry flood insurance if they have a federally related mortgage. So let's go a little bit deeper into that. If you've ever heard of FEMA and you wonder what FEMA stands for, it stands for the Federal Emergency Management Agency. On the exam, oftentimes we talk about acronyms during study, but we typically spell out what it stands for. But if for some reason you saw FEMA, because it is so well known as FEMA, Federal Emergency Management Agency, how is it that they participate in this class? FEMA draws the flood maps. And so these change from time to time. Think about this. If you live in an area that there is a lot of growth and there's a lot of concrete going down because of that growth, think how that changes the flow of waters. So FEMA can change the flood maps from time to time, and they do. So it's always important when you're working with a client to investigate all things. You do your inspections, you do your surveys, you do this, you do that. You also should be checking the FEMA flood maps. Now think about this. If for some reason you sold a client a house and that was in a flood area and they were not expecting to pay that insurance, then depending on where they are, flood insurance could actually get expensive. It's not always expensive in inland areas, but having said that, depending on the nature of the flood area, it could get expensive, and it would be a calculation that your client would want to make sure that they take into consideration. So FEMA draws the flood maps, and you can find these flood maps pretty easily at FEMA.gov. There are other sites that do this, and in your county, they would also have flood maps as well. But FEMA.gov is a fairly user-friendly way to find out where the flood areas are, flood hazard areas are. I want you to take note of this. Now, notice I put the note in red on your slide. We don't know exactly what we're going to be tested on when it comes to the actual state and national exams. Having said that, though, the commission put a note in the syllabus that said exactly this. We just took and cut out the note and we put it on this particular slide. So it leads me to believe that it is an area that you would want to know this, if not verbatim, at least to be able to recognize it verbatim. The 100-year floodplain refers to a flood having a 1% chance of equaling or exceeding the map elevation at any given year, not a flood that occurs only every 100 years. Now, you may look at that and say, what's the semantic difference between that? It's not relevant on this. Flood areas are determined by an elevation or an elevation certificate. And basically what they're saying is, you know what, there's a 1% chance that flood waters may rise above this elevation in any given year. So that's actually what they mean by a 100-year floodplain. In reviewing the contents of this chapter, I realized there were some words that were not covered that are on the syllabus, so I wanted to take the opportunity here to mention those to you. So property insurance, other vocabulary of note. You see the first item there, very, very simple actually. Insured versus the insurer. It's exactly what you would think that it means. In a lot of chapters we've done this where we would talk about the lessor, the lessee, and it's really all about you reading a problem. The insured is the person that has the policy. So if I'm the homeowner, I would be the insured if I buy the policy. The insurer is clearly the insurance company. The word endorsement I do not think has come up in the talk so far, so I want to make sure that you had an adequate definition of that. You may be more familiar with an endorsement as being referred to as a rider. If you have expensive personal items in your home, now keep in mind an HO3 policy would actually be a package policy which would cover both your real property and your personal property, but they put limitations on your personal property. So if you had expensive items like jewelry or artwork, you might want to look into purchasing a rider to make sure that they are covered to the full extent that the insurance company is willing to cover it. And they'll be glad to do it. You just have to pay more. The word exclusion came up in another section of the class, so let me just remind you of the most basic exclusion that you'll run into. Flood insurance is an exclusion. Your policy will not cover you for flood. Now we know by this point that you can get insurance through the National Flood Insurance Program as indicated by FEMA. It would be sold to you by your local insurance agent, so they could sell you this policy just like they would sell you your normal policy as well. Coinsurance is a little bit tricky, but the good thing about it is we're not going to test you that deeply on it, if at all. Coinsurance, the idea is that the insurance company requires you to maintain a certain level of coverage on your property. For example, if you fall below 80% of the value of your property on coverage, you would be considered underinsured. And the insurance companies, I'm not going to say they're okay with it, but they will sell you a policy where you're underinsured. But what they'll do is they'll say, if you're not going to buy the full property value of if you're not going to buy a policy that covers the full value of your property, at least up to 80% of the value of the improvement, then anytime there's a loss on the property, you're going to have to pay a percentage of what you were underinsured. So what does the coinsurance clause do? It says if you're underinsured, you're going to share it with the insurance company in every loss. We used to do a math problem on the exam. However, we have dropped that because coinsurance is a little more tricky than what we made it sound like. You're not going to give advice to your clients on this as an agent. You're completely going to let their insurance agent explain this to them. But the idea of coinsurance is make sure you're not underinsured, and ultimately if there is a loss, then you would be covered to the full extent that you purchased in the property. If you're underinsured, you will not. The word premium might be self-explanatory. That's the payment that you make to the insurance company for the policy. As kind of a side note on this, if you have a federally related mortgage as a buyer of a property, your lender is going to require you to have insurance on the property. Think about it. It's your house, but it's their collateral, so they want to make sure it's always insured. To the extent that if you do not carry insurance on the property and you still have a loan, the lender will go out and buy a policy for you. And then what they'll do is they will charge that premium directly to you in your monthly payment. It will almost always be more expensive, and it only covers the improvement. In other words, the bank's only concerned that their improvement is covered. They're not worried about your personal property and things like that. And then finally, package policy. We have alluded to this a little bit earlier. Your HO3 policy includes not just not just real property, but also personal property, and it also includes casualty insurance. So if something were to happen to the property, you would be covered for that. But it also includes liability coverage in case someone were to come on the property and be injured on your property. And then finally, it is vital for property insurance to be maintained. Now, you wonder where the broker's role is in this. Why are we talking about this? There are insurance agents, there are insurance brokers out there. Yes, there are, but they're not heavily involved in the process. It's one of those things that's often overlooked by buyers and sellers for that matter if there's going to be a possession issue. But having said that, as the broker, what you need to do is make sure you advise your client to get in touch with your insurance agent early. That way that they will have time to put a policy in place. They will have time to determine what the price of that is going to be, and they're going to have time to determine what effect the actual property is going to have on the price. And for example, I recently sold a home, and one of the things that the homeowners insurance company asked for is, could you tell us the age of the roof and the HVAC system? Fortunately, we were able to produce receipts showing that the roof was only about 5 years old and the HVAC was only 3 years old. That turns out to be a benefit for the buyer, not only because he doesn't have to worry about replacing them for a while, but the insurance company can feel comfortable that they're probably not going to be in a situation where they're going to have a claim filed on one of those items. Now, obviously, that doesn't take into consideration if a tree falls through the roof. Obviously, the insurance company is going to cover that, and they're going to cover it at a premium because that roof is only 5 years old. Had that roof been 20 years old, the insurance company may have excluded that from its coverage because it was already past its useful life. So it's vital for property insurance to be maintained. It's vital for you as the broker to make sure that you're getting your clients to be in touch with their insurance agent. And think about this, as for first-time home buyers, they may not have an insurance agent. So it would behoove you as an agent to be able to have those resources that you could introduce the buyers to those. That's it. That's the end of the property insurance chapter. As you're reading through your book, please take all test information that comes along with this. Keep an eye out for words that we may or may not have covered in here because this is a vocabulary section. And then understand the flood process from FEMA as well. FEMA draws the maps. If you're in a flood area, you're going to have to carry flood insurance. That flood insurance is administered through a policy called the National Flood Insurance Program, NFIP, and it's actually sold to you by the same agents that would normally sell you your homeowners policies. It's just administered through FEMA and NFIP. So anyway, there are some more obvious areas for testing purposes. Keep your eye on those, and good luck.